All right, welcome to this Masterclass Explainer. Today we're going to logically break down the absolute core driver of the financial markets. I'm talking about supply and demand. You can forget about all those cluttered indicators, complicated fundamentals, or the noisy news feeds. As your mentor today, I'm going to teach you how to read the true language of the market. Sound good? Let's dive right in. Over the next few minutes, we're going to run through this syllabus. We'll hit the core market imbalance, defining trading zones, spotting institutional footprints, grading your trade zones, executing the strategy, and finally, the golden rule, risk. We're building this step by step so you can look at your charts with total objectivity. Part 1. The core market imbalance. Let's start right at the absolute foundation and understand why price actually moves in the first place. I absolutely love this analogy from the Set and Forget Trading Academy. A power saw has many advantages. However, if you don't learn how to use a power saw, you can cut your fingers off. It perfectly hits the nail on the head. Jumping into trading without understanding supply and demand is, literally, incredibly dangerous. Your broker honestly doesn't care if you grab the saw blindly. They collect their commissions either way, right? But as a professional, you have to master the tool before making a cut. So what is a market imbalance? Well, we have to understand that every single movement in any market, stocks, forex, crypto, you name it, is driven purely by this massive tug of war between buyers and sellers. It's a temporary state where what buyers want to buy just doesn't match what sellers want to sell. When demand exceeds supply, prices shoot up. When supply exceeds demand, prices drop. It's a fundamental law. It's kind of like gravity. Okay, moving on to part 2, defining trading zones. Now that we've got the theory down, let's translate this into how it actually looks in the real world. Just picture your local farmer's market for a second. Let's say there's a sudden shortage of a really popular fruit. What happens? Intense buying interest. People will literally pay higher and higher prices until that fruit is completely gone. That right there is a demand zone, a solid price floor where demand absolutely crushes supply. But on the flip side, if every single farmer shows up with just an overabundance of tomatoes, well, they have to slash prices to attract buyers. That glut of inventory, that creates a supply zone, basically a price ceiling. Capitalism basically rules the markets like a giant seesaw, constantly tilting back and forth. Buyers and sellers are locked in this never-ending battle, just trying to find a fair price equilibrium. And when that seesaw tips heavily to one side, boom, a major imbalance occurs. And as traders, we're on the hunt for those exact moments. Part 3, spotting institutional footprints. So, how do we actually spot these massive imbalances on our vertical phone screen or your trading monitor? We have to look for the tracks left behind by the big players. When you first look at a chart, your job is to spot this very specific 3-part sequence. High-quality zones do not just appear out of nowhere, they have an anatomy. First, you get an impulse move, a really strong push. Second, a base, which is a brief pause or consolidation where institutional orders are quietly accumulating. And third, the departure, an explosive, aggressive exit away from that base. That tight little base, that is our zone. To put that into perspective, check out this weekly chart of the Australian dollar. Notice that highlighted blue box and see that massive, explosive black candle dropping violently away from it? That sharp drop is the exact, undeniable signature of a powerful supply zone. Sellers completely, and I mean completely, overwhelmed the buyers right there. Now, depending on the trend, you're going to be hunting for one of 4 structural patterns. You've got rally base drop or drop base rally, which represent major market reversals, your ceilings and floors. Then you have rally base rally or drop base drop. These are continuation patterns. This is where the price simply pauses to catch its breath, builds a quick base, and then just continues exploding in the exact same direction. Now, precision matters when drawing these zones on your chart. You want to capture the full battleground. For a demand zone, you're going to connect the lowest wick of the base up to the highest body of those base candles. For a supply zone, do the opposite, highest wick down to the lowest body. Just draw your rectangle and extend it out to the right. You are literally mapping out the exact coordinates where big institutional orders are parked. All right, part 4, grading your trade zones. We have to be highly selective here, because let me tell you, not all zones are created equal. Some are going to hold like an absolute fortress, while others will fold the second they're tested. So here is the secret ingredient. Focus only on fresh zones. A fresh zone is an area that price has not yet returned to since it was originally formed. Why is this absolutely crucial? Because a zone is at its strongest on its very first retest.
Those original massive blocks of unfilled institutional orders, they're still sitting right there, just waiting to be triggered. If a zone has been tested multiple times, those orders are getting chewed up and depleted. Which brings us to part 5, executing the strategy. We've done the analysis, now let's talk action. How do we actually trade these fresh zones and build a real professional framework?
Keeping things beautifully simple for our vertical display, this table summarizes our entire core rulebook. Inside a demand zone, buyers are in control. So what do? We look to buy. We go long. Inside a supply zone, sellers have control, so we look to sell or go short. That's it. We don't overcomplicate the whole shebang. As a trader, you essentially have 2 main approaches here. First, zone reversal. This is where you try to catch a major turning point by placing an order right as price touches a fresh, untested zone. Or there's zone continuation. This is where you go with the flow of an already established trend, using those mid-trend bases we talked about as super low-risk entry points on a pullback.
And finally, part 6, the golden rule, risk. I need you to listen to this final chapter very, very carefully, because frankly, all the chart analysis in the world means absolutely nothing without this next part. Precision beats quantity every single time.
As your mentor, I see new traders fail constantly for a few specific reasons. They clutter their screens with dozens of lines and zones, and they completely ignore the broader, higher timeframe context. They just trade every single base they see entirely blind. Look, supply and demand improves your probability dramatically, but it is not some magical certainty. Remember our power saw analogy from the very beginning? If you want to keep your fingers safe, you must use professional safety measures. You have to place your stop loss strictly, just outside the extreme edge of the zone. You must maintain a fixed risk per trade. Avoid overexposure to just one setup. A failed zone is literally just a normal part of statistical probability. Poor risk management, though, that's a choice. So I'm going to leave you with a question to fundamentally challenge your habits. Are you chasing the price, or are you letting the price come to your zone? Amateurs get impatient. They chase the market, jumping in way late when the move is already gone. True professionals, they map out their high-quality, fresh supply and demand zones. They set their alerts, and they patiently wait for the market to come to them. Which one are you going to be? Thanks so much for watching this explainer, and I will see you in the markets.